The next category we'll talk about are creative supplies. Here is where this gets a little interesting because the supplies you purchase that you put into your work, the direct materials that go into the work that then eventually get sold, that is deductible to you. But there might be a timing issue. You probably remember once upon a time, several months ago, we talked about a balance sheet that showed your assets and liabilities versus your profit and loss statement, which showed income and expenses. When you purchase supplies, you essentially trade one asset for another. You trade cash for the supplies. You go to the store, you give them cash, they give you supplies. So you're trading one asset for another. Then you're taking the supplies and then you're turning them into something magical, right? You're turning them into your inventory. That is still an asset to you. It only becomes an expense when you sell the piece or sell the inventory and you get cash for it, and then you get the business deduction for the cost of sales or cost of goods sold, right? So all of those supplies you're purchasing are deductible to you, but there's a timing issue because technically they're only deductible when you sell the work. That means whatever you have left over at the end of the year is in your ending inventory. That's an asset to you that doesn't become a deduction until it leaves your studio and goes to wherever it's going to go in exchange for money or cash. You'll see on Schedule C, there's a way of calculating this amount that basically starts with your beginning inventory at the start of the year. So this is, what do you have in your studio at the beginning of the year? What supplies do you have on hand? What works in process? What finished goods? What is your beginning inventory at the start of the year? Then we add in everything you purchased during the year. So all the supplies you bought during the year, that amount gets added to your beginning inventory amount. Then we subtract whatever's left over in your studio at the end of the year. What supplies do you have that you haven't used yet? What works in process do you have? What ending inventory do you have that hasn't sold, right? So we start with beginning inventory. We add in everything you bought during the year. Then we subtract what's left at the end of the year. And that math equation gives us your cost of goods sold because you have it at the beginning or you bought it. And then if you subtract out everything that you still have at the end, the difference has to be everything you sold, right? Your cost of goods sold or your cost of sales. Using this formula also accounts for like spillage or spoilage, right? So let's say you purchase a tube of paint. You're never going to use the color except for this one piece that you're working on, right? You use, say, 2/3 of the tube, and then at the end, you throw it away because you hate the color. You're never going to use it again, right? It's not still there at the end of the year, so it makes its way into the cost of goods sold deduction, whether it is spilled or thrown away or spoiled or actually sold.